Hello traders, in this video we will see what are the terms in options. Before trading in options, some of the basic terms have to be understood, or else it will be very difficult to trade. First one is call options. So I'm explaining about call options and put options in very simple terms. In detail I will discuss it in next video. What is call options? So consider if a person predicts that the price of a stock or index will increase in future, he will buy the call options. I will show you in Opstra. So consider I'm taking Nifty options. I'm choosing a 13th of October as an expiry date. So Nifty current spot was around 17,000. You can see here spot price around 16,983. So 17,000 is the money. So 17,000. The price was 96 rupees. So I am expecting market to go till 17,200 for the expiry 30th October. So I am choosing this strike option and I am buying. So these are all calls, these are puts. So call strike. So I am expecting the price will increase. So 17,200 I am buying. So lot in Nifty, one lot is 50 quantity at position. Here you can see the chosen strike price was 17,200. That is 36 rupees. So I am here 36 rupees into 50 quantities, that is one lot is 1,800 rupees. So 1,800 is the amount we have invested. So the maximum loss you will get is the premium that you paid for this strike. So there will be a break-even point calculated for your contract. It is calculated by, in case of call option buying, the chosen strike price plus the premium you paid, 17,200 plus the premium you paid for that strike 36. So 17,236 is the break-even point. So after the break-even point, this is the break-even point. After the break-even point, each point after that break-even will be considered as a profit of 1 rupee. So for example, if the price reaches 17,300, so 17,300 at the end of expiry, the break-even price 17,236. So there will be a profit of 64 points. 64 points is the profit. So you what? One lot is 50 quantity. You have bought 50 quantities. 64 into 50 is 3,200 will be your profit when it reaches 7,300. So the index can go up to the higher level at any point. So the profit will be calculated in this method. Similarly, in case of put options, if a person predicts that the price of a stock or index will decrease, he will buy some put options. I will explain it through the same Opstra, so that you will be understanding in a very good manner, in good way. Opstra. Same Nifty. Now we are predicting market will go below 16,800. The strike price was 48. 16,800. The strike price was 48 by one lot for Nifty. So 800 plus 48, 16,000. In case of put options, the break-even points are calculated by the strike that you have chosen, 16,800 minus the premium that you paid. So 16,752 is the break-even point. After 16,752, the market's movement will be calculated as each point will become 1 point as your profit. So the market falls till 16,000, the profit will be calculated by suppose the spot reaches 16,000 minus 16,752, so almost 750 points is profit. 750 into 1 lot is 50 quantities, the profit will be 37,500. This is called option buying. This is called option buying for put options. So I have discussed call options and put options in a very simple manner, not in detail. I will discuss it in detail in a separate video. I am just explaining the terms involved in the options. Then strike price. Strike price is very important. So for stocks, the strike price is the price of that stock, particular stock underlying. I will explain it in option chain. So in option chain you can get everything. So I will just show you how to go to option chain. Open mscindia.com. Then here there will be www.1.nse.com. Click that. Then in the live market you will see option chain, and in option chain equity derivatives have to be clicked. In this equity derivatives you can see the here Nifty expiry is 13th expiry. So these are the strike price. I'm circling it, strike price. These are the rest of strike price. This left side is calls, right side is puts. When the spot place of strike price is called at the money, and the strike price away from the spot is, these are out of the money strike prices for call, and these are out when the strike price is below the spot price. These are called in the money for calls, which is vice versa for put option. Opposite, it is the strike prices that is away from the spot price will be in the money for put options. The strike prices that are below the spot price are called out of the money put options. Next was, so for index, the Nifty 50, the strike price will be arranged in a 50 points interval. See, 17,000, 17,050, 17,100, 150, 200, likewise. In case for Bank Nifty, the strike price will be arranged in a 100 points interval. 17,100, 30, 38,700, 3800, 38,900, and it keeps going on. And for Fin Nifty, same 100 points. 500, 600, 700, 17,700, 17,800, likewise. So what is the price value of the particular strike price? See, in this strike price you will see strike price and left LTP, last traded price. This is the premium that you are going to pay in case of option buyer. In case of option seller, this is the premium that you will collect it. Fine. This is the premium for calls, and this is the premium for puts. Usually the premium for puts will be higher than the calls during at the money, because there will be more fear in downwards than the upside. This expiry. This is very important. So what is expiry? The contract that you buy have a time period. Usually the time period for options contract for a Bank Nifty and the Nifty 50 will be Thursday of every week. In case of a national holiday, then the expiry will be the Wednesday, the day before the holiday. And for Nifty, the expiry day was Tuesday of every week. So I will show you here in the option chain. See here in the option chain for Nifty, the expiry date was 13th, which is Thursday. 20 next October 27. These are all Thursdays. Okay. So up to 3 months we will get a weekly contracts. Then for each financial year you will get an expiry 3 months. See, March and June, September, December, all quarterly expiries you will have. So I will here show you for stocks. I am taking Reliance as an example. It will be monthly expiry. See, October, November, December. It will be available only for the 3 months. I have said strike price for stocks will be the price of that stock. That's all in the option chain. Then so through this option chain you will get the data that corresponding to this to its expiries. It will be very easy for you to interpret and take trades. So in the option chain, what are all the other data that you can get? Strike price, I have told you. Last trigger price is the premium that you are going to pay in case of option buyer, and in case of seller you will collect it. And asking quantity is the lots asking price will be set by sellers, bid price is by the buyers, the quantities of the corresponding price, and IV is the percentage of chance that the price will go there, and volume is number of quantities that are traded in that strike price. And open interest is very important. Open interest is the number of contracts that are active in that particular strike price, which is Nifty. So for 13th October Nifty, the 18,000 call option have the highest. 18,000 call option have the highest open interest. I'm just marking here. 18,000 call option has highest open interest. So through this open interest numbers, you can fix it as a resistance. So in the higher side, the calls in the higher side, the strike which has higher open interest will act as a resistance. In case of put option, the strike price that have higher open interest will act as an highest open interest will act as an support. So change in open interest, this changes as per the market movements. So these are the basics that you should know before trading in options. Without knowing this, it will be very difficult to trade in options. So about options buying and selling, I will come up with the next video. Thank you.